In recent times, Bitcoin's journey has been marked by high expectations, particularly with the anticipation of its integration into an ETP similar to ETS. This move was expected to attract a wave of new investors, prompting billions of dollars to flow in, with many hoping to get ahead of those who would buy the ETP upon its launch. However, the reality paints a different picture. Notably, American TV personality Jim Cramer is making a final plea for individuals to sell their Bitcoin.
By the way, we've seen Bitcoin double in anticipation of being wrapped up into an ETP, that's a cousin of ETFs, that was supposed to bring in many, many new investors. Billions upon billions of dollars came in to run ahead of the suckers who would buy the ETP when it was launched.
He argues that the ETFs have fallen short of expectations, labeling those who bought into them as suckers. The launch itself has been quite tumultuous, with an actual outflow of crypto ETP money observed over the past few days. Now, let's delve into the numbers. Contrary to the initial projections of tens of billions of dollars pouring in, the actual net new money that has entered these new spot Bitcoin ETFs in the 2 weeks since they started trading is less than $1 billion. This significant discrepancy between expectations and reality raises questions about the current state of Bitcoin investments. In a recent update, BlackRock's ETF has amassed approximately $2 billion in Bitcoin, making them significant dip buyers in the market. Fidelity closely follows suit, while Grayscale is undergoing substantial selling. Interestingly, Grayscale initially held over $26 billion in Bitcoin, some of which has been locked up for years. Notably, investors who entered the Grayscale Bitcoin Trust at 2% face a unique situation. Many purchased the trust at Bitcoin prices ranging from $50,000 to $69,000. When the ETF became available, allowing them to sell the Grayscale Bitcoin Trust and incur a loss for tax purposes. There's a catch: they must wait for 30 days before reloading. Despite the wait, this presents an arbitrage opportunity for these investors, transitioning from a 2% trust to a 21 basis point ETF.
Coming in. You know, the entire market cap of Bitcoin was $487 billion on June 14th when BlackRock filed for their ETP, and then it rallied to $920 billion right before the spot ETP started trading, as Bitcoiners all over the world ran ahead of all the suckers who were supposed to come in and take them out of the trade.
As Bitcoin enthusiasts anticipated an influx of new investors, the market experienced a 20% dip, presenting a classic buy the dip opportunity.
Well, now Bitcoin's up a huge amount, and the expected boom is a bust. That means Bitcoin speculators are up huge, and the legendary Larry Williams, who predicted the exact top, is now saying that people are getting still one more chance to sell Bitcoin. But then it's all over but the shouting. Man, you know what? You can buy a lot of cashmere sweaters, a whole closet of them with that pricey Bitcoin. But the bottom line, as Wall Street increasingly realizes that it's time to ring the register, ka-ching, ka-ching, I'm begging you to take something off the table if you haven't done so already.
Jim Cramer's track record has been marked by instances where his advice urged buying when selling would have been wise, or vice versa. Now presents another opportunity to reconsider crypto investments. Looking back at the start of 2023, Bitcoin witnessed a 40% surge, but things took a different turn. Drawing a parallel, consider Netflix initially suggested as a buy, yet it experienced a significant 57% drop. This phenomenon is aptly named the reverse Cramer effect. Even in historical events like the Bear Stearns collapse during the 7-8 housing market crisis, Jim Cramer's recommendations didn't always align with market realities. His advice during such critical times may not have served investors well. It's essential to be cautious and make informed decisions, especially considering the volatile nature of crypto investments. Reflecting on past events, when faced with the Bear Stearns collapse, Jim Cramer expressed confidence that the bear was solvent, dismissing concerns. This optimism conflicted with the grim reality that unfolded. Even Jon Stewart from The Daily Show confronted Cramer, questioning the inconsistency between his market knowledge and the sensationalism portrayed on his show. Cramer, a former hedge fund manager, is recognized for his intelligence. Despite knowing about questionable bank practices, he and the network continued to endorse them. In the present day, Cramer advises selling, promoting a disciplined approach. It's important to note that he doesn't advocate selling everything, but recommends making strategic adjustments. This nuanced perspective encourages investors to exercise caution and consider a measured approach to their crypto holdings. While there may be concerns about regretting decisions, especially in regard to profits from BlackRock, Fidelity, and Grayscale, it's wise to acknowledge that taking gains at the top of market cycles can be a smart move. However, it's crucial to have accurate information. The Grayscale selling, though perhaps larger than anticipated, is nearing its end. BlackRock has made a significant impact on the Bitcoin ETF scene, surpassing GBTC volume for the first time. Recent data indicates that Bitcoin surged by 5% after Grayscale ETF outflows dropped nearly 50%, now standing at only $255 million. This trend suggests potential further gains when these outflows cease. In comparison to traditional markets, Bitcoin ETFs have proven to be quite successful. Since the beginning of 2023, over 600 ETFs have been launched, and BlackRock's Spot Bitcoin ETF is already among the top 3 in terms of current assets. Anticipating even more growth, BlackRock is poised to claim the #1 spot by the following week, with Fidelity also ranking in the top 7. Notably, this is all transpiring before the onset of major advertising, as Google has started Bitcoin ETF ads from January 29th.
Cryptocurrency does not seek to replace currency. It's a bad name. Cryptocurrency seeks to replace banking.
In this concise clip, expert Brian Brooks sheds light on why Jamie Dimon harbors animosity towards Bitcoin, breaking down the fundamental shifts in the financial landscape. Brooks emphasizes that the core functions of banks, established since the 1300s, are on the verge of significant change. The origins of banks in 1340s Italy were driven by accounting advancements, enabling them to act as trusted intermediaries between parties with financial obligations. In those times, people would exchange notes, promising payment, and banks emerged to streamline this process, albeit at a cost. However, Brooks argues that with technological advancements, the need for a trusted intermediary to manage ledgers has become obsolete. Similar to how email replaced postal clerks, cryptocurrency seeks to transform the banking landscape. Brooks contends that banks won't disappear entirely, but will evolve into specialized entities, focusing on high-value services like structured finance and investment advisory. Cryptocurrency, as Brooks asserts, doesn't aim to replace currency. Instead, its purpose is to revolutionize the core functions of banking. This perspective offers insight into the transformative potential of cryptocurrency in reshaping traditional financial structures. If you found this video valuable, don't forget to like this video and subscribe to our channel for more insightful updates on the crypto market. Must share your thoughts in the comments section below. Thank you for watching. Remain steadfast until next time.